Before we have our wonderful lunch, we're going to have a wonderful speech by the former governor, my good friend Haruhiko Kuroda. And I have to say, it's been no more fun for me in central banks but to spend some time at the Bank of Japan. It's a real treat. If you ever have a chance, go and do that. You learn so much about different ways to do policy. But we're so interested in what's happening in Asia and Japan, and we can't wait to hear your talk. So welcome so much. Thanks for being here. Take over. Okay.
Thank you very much indeed for your kind introduction, John. I have been getting in touch with him for the last 20 years or so, since he was Undersecretary for International Affairs of the Treasury in early 2000, and I was at that time Vice Minister of Finance for International Affairs, and we discussed about many things, including ways to help Afghanistan and Argentina, and also foreign exchange policies and so on and so forth, except for the Taylor rule. Because in the US as well as in Japan, monetary policy is exclusively decided by the central bank. Anyway, I would like to talk about inflation targeting in Japan, 2013 to 2023. Japan started the 2% inflation targeting in 2013 and have continued it until 2023. And yet, the 2% inflation target is not achieved in a sustainable and stable manner. The current inflation of 3 to 4% is almost wholly caused by import price hike and will slow down to less than 2% by the middle of fiscal 2023. However, the so-called no price increase and no wage increase norm is apparently changing, and long-term inflation expectations are rising. And further labor supply increase is unlikely because already female labor participation is higher than in the United States and many other developed countries. Therefore, by continuing accommodative monetary policy so that firms can continue to raise wages by around 3%, the 2% inflation target will be achieved in a sustainable and stable manner in the near future. The Bank of Japan adopted the 2% inflation target in January 2013, and at the same time also agreed to the joint statement with the government in which the bank committed itself to achieve the 2% inflation target at the earliest possible time by executing monetary easing. These decisions were taken before I joined the bank in March 2013. Actually, the Bank of Japan, under continued deflation since 1998, had introduced quantitative easing, or QE, in 2001, expanded it step by step in 2003 to 2006, and began to include long-term JGBs as well as CP, corporate bonds, and ETFs in 2008 to 2013. But deflation persisted with low growth and high unemployment. Actually, the average inflation rate in 1998 to 2012 was minus 0.3%. Fairly mild deflation, but quite persistent. Among 15 years, 11 years recorded negative inflation rate. Growth rate was only 0.6%, but more serious was unemployment rate continued to be close to 5%. So, in April 2013, the Bank of Japan substantially expanded QE by doubling the purchase of JGBs and the monetary base in order to achieve the 2% inflation target at the earliest possible time, with a view to achieving it in 2 years. The bank called this as the quantitative and qualitative monetary easing, or QQE. Initial reaction from the economy was quite significant. Economic growth recovered and stock market rebounded, while the CPI inflation rate reached 1.4% by spring of 2014. However, the increase of the consumption tax rate from 5% to 8% in April 2014 and still sluggish wage increase made personal consumption deteriorate, with the CPI inflation rate declining. So, in October 2014, the Bank of Japan expanded the QQE by substantially increasing JGB purchase with longer-term maturities and committing higher increase of base money. However, oil prices, which had been around $100 per barrel, declined toward $50 per barrel in 2015 and reaching less than $30 per barrel in early 2016, reducing the CPI inflation rate to zero. Actually, the inflation rate in 2015, the average was 0%, although growth rate was 1.6%, and unemployment rate declined to 3.4%. So in order to further lower the entire yield curve, in January 2016, the Bank of Japan decided to introduce the negative interest rate policy by imposing minus 0.1% policy rate on one of the 3 tiers of demand deposit at the bank, while it lengthened remaining maturities of JGB holdings further. The bank certainly learned from the experiences of the negative interest rate policy utilized by the ECB and the other European Central Bank, so as not to undermine financial intermediation by the banking sector. Thereafter, considering unstable international financial markets and weakening emerging market economies, in July 2016, the bank decided to expand the QQE by increasing purchase of ETFs and declared to make a comprehensive examination of the QQE with negative interest rate. Then, in September 2016, after the comprehensive examination, the bank introduced the yield curve control, YCC, accompanied by a new forward guidance to continue monetary base increase until the 2% inflation target is achieved, and widened operational tools. The CPI inflation rate recovered toward 1%, although because of the consumption tax rate increase from 8% to 10% in October 2019, inflation slowed down slightly. The inflation rate in 2016 to 2019 was around positive 0.5 to 1%, and growth rate continued to be positive, and also unemployment rate declined to 2.4% in 2019. That means that the unemployment rate was almost halved compared with the long deflationary period. Then, in early 2020, the world economy was seriously affected by the COVID-19 pandemic. reducing supply as well as demand, so that it became mired with negative growth and deflation. Japan was no exception. So 2020 and 2021, inflation rate became negative, although growth rate recovered in 2021. And interestingly, unemployment rate continued to be fairly low, middle of 2%. By 2022, the pandemic became less severe and the world economy started to recover. But then the war in Ukraine erupted in February 2022, which raised energy and food prices enormously, resulting in extremely high inflation, the highest in the last 40 years. Again, Japan was no exception. Inflation rate in 2022 was 2.3%, and now it's slightly above 3%. Again, interestingly, unemployment rate continued to be middle of 2%, quite low compared with the deflationary period. So as I said at the outset, although the current CPI inflation rate is 3 to 4%, it will slow down to less than 2% by the middle of fiscal 2023. However, the important fact is the 15-year-long deflation has been overcome with substantial employment increase and wage increase. Actually, the hourly wage increase during 1998 to 2012, the 15-year deflationary period, was minus 0.4%, while in the last 10 years, hourly wage increase, average hourly wage increase was positive 1.1%. And more importantly, employment in 2012, just the end of the deflationary period, number of employed persons was 62.6 million, while the latest figure of the number of employment is 67.3 million. That is more than 4 million jobs are created, 4 million employment increase. And more importantly, employment income also increased about 20% compared with 2012. And corporate income, by the way, almost doubled compared with 2012. So based on the significant improvement in the economy, we can now envisage the 2% inflation target would be achieved in the near future. I'm sure that without the clear 2% inflation target and strong commitment by the Bank of Japan, we could not have overcome Japan's persistent deflation. At the same time, with various shocks coming from inside as well as outside of Japan, and above all, with the aftermath of the 15-year-long deflation, i.e. entrenched deflationary mindset, achieving the 2% inflation target within a reasonable time span has been difficult. Having said so, I must emphasize that there appears no other policy framework other than the inflation targeting to achieve price stability, which is the main mandate and objective of any central bank. Thank you.
One of the controversial tools that you used in this process of bringing disinflation to an end was the YCC. And when I teach monetary policy and the Taylor rule,
Yeah.
and I go and teach Japan, my students say, how can you
Yeah.
attempt and be successful without creating great distortion, fixing and targeting both the short-term and longer-term interest rates? So could you comment a little bit on that?
Yeah. I think we call yield curve control with, QQE with the yield curve control. So the basic structure, nature of the QQE continues. Of course, initially with negative policy rate, and then with negative policy rate coupled with 10-year JGB rate target. Why we changed from simple QQE to QQE with the yield curve control? Main concern was, of course, maybe two things. One, targeting the amount of JGB purchase and asset purchase program, of course, had some strong impact on market expectation and so on and so forth. But at the same time, you can imagine that depending on overseas financial market conditions and so on and so forth, even if you continue to make 80 trillion yen JGB purchase every year, the long-term interest rate may fluctuate somewhat. So we thought that by targeting 10-year JGB rate at around 0%, we can fix the strength of monetary easing more than the simple QQE. The second point is, of course, 80 trillion yen JGB purchase and so on and so forth. These may be understood by financial market people, but ordinary household and ordinary company managers do not understand what is 80 trillion yen. Better to say that we will target 10-year JGB rate at around 0%. That could be more transparent, understandable, and make the QQE more effective. So we introduced YCC, and of course it is somewhat unusual. Many central banks adopted some kind of QE after the Lehman crisis, but none of them adopted yield curve control. They, of course, introduced minus or quite low short-term policy rate, but never intended to target long-term interest rate. That is true. That is somewhat unusual, but we thought it was more effective and more transparent and could be good. And of course, that could make JGB market people less happy or unhappy. That is true. But we still think that this YCC was appropriate and will continue to be appropriate until the 2% inflation target is achieved in a stable manner.
Thank you very much. Beat Siegenthaler of Rockcross Capital. The market is debating a lot of what could happen once the system is
Yeah.
being unwound.
Yeah.
And we're seeing in the US, and this morning we discussed about what can happen when you have years and years of a lot of liquidity in the system, and then once you withdraw it, rates go up, you see an impact there. Now, in Japan, I'm wondering, how dangerous is it going to be when eventually the system, monetary policy, will be normalized, and how disruptive could it turn out to be? Thank you.
I think once the 2% inflation target is met in a sustainable and stable manner, the Bank of Japan would start normalization, meaning raising policy rate, and of course gradually reducing asset purchase and so on and so forth. Now, then there would be various impacts on the financial sector, household, companies, and also the government. Now, as far as the households are concerned, you may know that Japanese households have about 6% of GDP equivalent debt, mainly housing purchase debt. But at the same time, Japanese households hold something like 2,000 trillion yen financial asset, which is roughly 4 times of GDP. So even if interest rates are raised and that could affect some households which has a significant amount of housing loan and so on and so forth. But households would, generally speaking, would benefit from rising interest rate because they hold huge amount of bank deposit. Ordinary firms, after the Lehman crisis, they reduced total debt, but now they increased to the level beyond the level prevailed before the Lehman crisis, which is about 120% of GDP. But Japanese companies and firms hold something like 60% of GDP equivalent cash. And the former finance minister always criticized the Japanese companies why they have so huge amount of cash instead of raising wages or increasing investment. So firms have enough liquidity and even if monetary situation is tightened and the interest rate rises, no major impact is likely. Now, the Japanese financial institutions, they have substantial capital basis and also liquidity is quite abundant. And by the way, in Japan, the deposit insurance scheme is quite interesting. On the one hand, there is some upper limit for ordinary deposit, but demand deposit without interest payment would be insured without limit. So entire amount of demand deposit without interest payment would be insured by the deposit corporation. And so FSA has been making various stress tests on mega banks as well as local banks, and they found that they have enough capital as well as enough liquidity and so that I don't think even interest rate goes up and monetary situation become tighter. I don't think the banking or financial sector would be affected quite seriously. The only entity which will be significantly affected by the monetary normalization is the government. Government has more than 200% of GDP equivalent debt. By the way, when I was Vice Minister of Finance around 2000, like him, at that time, Japanese government national debt burden in terms of interest payment was about 10 trillion yen. And the current budget shows the interest payment by the government is only 8 trillion yen, while the stock of government debt more than doubled, actually more than threefold. And yet the interest payment declined. That means that if monetary situation is normalized and the interest rate would rise, and eventually Japanese government interest payment burden would more than threefold increase. So from 8 trillion yen to 30 trillion yen, something quite huge. Of course, not instantly, but it will take 5-6 years because the average maturity of JGB's outstanding is, I think, 8 years or 7-8 years, including 10-year, 20-year, 30-year JGBs, so that roughly in 5 years, more than half or nearly 2/3 of JGBs would mature, so that in the next 5 years or so, after monetary normalization, government debt burden would increase substantially. I have been telling the government this is the case. They know, but I don't know whether politicians understand the situation.
Thank you.